Yeah, good evening, sir.
Okay, so you are welcome to Advanced Tax class. So today we'll be looking at taxation of merger and acquisition. We'll be looking at taxation of merger and acquisition. So we start. I've sent the lecture material to the group chat. So I don't know whether you get it.
So I've seen it there.
Okay, thank you. So we start with what is merger? Merger simply means it's a form of business combination where two or more companies join together to become one enlarged company. The meaning of merger means company A and company B, they are joining together to become AB Limited. They are joining together to become what? AB Limited. Why acquisition simply means an arrangement whereby the asset and liability of a company is acquired by what? Another company. So that is meaning of merger and acquisition. Merger simply means business combination between two or more companies to become a larger surviving company. While acquisition simply means a situation whereby the asset and liability of a company is acquired by another company. Is acquired by another company. So that is acquisition. Now, let's go forward. Type of merger. Type of merger. Type of merger. There are two types of merger. We have horizontal merger and vertical merger. Horizontal merger and what? Vertical merger. What is horizontal merger? Horizontal merger means a situation whereby two companies in the same line of business merge together to become a new company, to become a big company. Example of horizontal merger: Standard Chartered Bank, Chartered Bank and IBTC Bank. They merge together to become what? A big one, which is called Standard Chartered Bank. They are Chartered Bank, IBTC Bank. They are in the same line of business. They are into banking industry together. They are now merging together to become what? A bigger company. That one is what? Horizontal merger. Vertical merger. What is vertical merger? Vertical merger simply means a situation whereby two or more companies in the same industry, in the same what? Industry, but different line of business. In the same industry, but different line of business. Merge together to become a big entity. Two companies in the same industry, but different line of business. They are merging together to become what? A big entity. Example of horizontal merger. Coca-Cola is a company. There is a bottling company called Nigeria Bottling Company. Coca-Cola and Nigeria Bottling Company now merge together. They now change their name to Coca-Cola Bottling company. That one is what? Vertical merger. That is vertical merger. Now, let's look at benefit of merger and acquisition. Benefit of merger and acquisition. Number one benefit is improved management. When two companies merge together to become one new company, the management, there will be effective management. There will be improved management service. Another benefit is increase in economic of scale. Their production level will increase. Their asset base will increase. Their size, their organization size will increase. Increase in market power. They will have more power when two companies join together to become a new company. They will have market shares. Market power simply means market shares. They will have more market shares. Another one, tax shield. Tax shield. When the two companies join together, it will, in the long run, it will save them some tax costs. Because if company A is paying tax, company B is paying tax, at the end of the day, the tax that two of them will be higher than for two of them to join together to become one. The tax that they will pay when they are one will be lower compared to when they are operating separate. Risk reduction. It will reduce risk. It will reduce risk. Merger is going to do what? Or acquisition. It will reduce risk because there will be sharing of risk, or there will be diversification of risk. There will be sharing of risk or diversification of risk. So all these are what? Benefit of merger and acquisition. Now, let's look at tax implication of merger. What is the tax implication of merger? Or new company taking over an existing company. You know, when there is merger, company A, company B, they want to merge together to become AB Limited. The idea thing is that company A is going to lose his brand. Company B will lose his brand. We also lose its brands. There is now a new company called AB Limited. That AB Limited, we are looking at it as a new company. We are assuming that company A have ceased operation. We are assuming that company B have ceased operation. So when there is merger, A and B want to merge together to become AB Limited. A will lose his brand. B will also lose his brand. There will be a new brand called AB Limited. So that's implication of mergers or new company taking over an existing company. What does that mean? AB Limited is the new company. It's taking over what? Existing company. It's taking over A. It's taking over B. What are the tax implications? Number one tax implication. The old company. Which one is the old company now? Company A, company B. They are the old company. So number one tax implication is the old company is deemed to cease business, while cessation rule will apply to the old company. A, we cease operation. B, we cease operation. Once they cease operation, cessation rule is going to apply to them. I think my colleague, Mr. Chris, will have taught you cessation rule, commencement rule. Has he discussed that? As Mr. Chris talk about cessation rule and commencement rule.
Yeah, he has. He has taught us.
Okay. So, number one tax implication of merger is the old company is deemed to cease business and cessation rule will apply to the old company. Number two tax implication, the new company in this case is the AB Limited, is deemed to commence a new business. Commencement rule will apply to the new company. That is number two tax implication. Number three tax implication, filing of annual tax return. The new company is required to file audited account or tax return within what? 18 months from the date of incorporation, or not later than 6 months after the end of his first accounting year, accounting period, whichever is earlier. That new company, they are required to file annual tax return with FRS within 18 months from the date of commencement of business, or 6 months after the end of the first accounting year, whichever is earlier. Number four tax implication. Number four tax implication now. Claim of capital allowance. A has ceased operation. B, they have ceased operation. There is now a new company called AB Limited under merger. But A, we have tax written down value on some of their qualified capital expenditure. B, we also have tax written down value. What will happen to that tax written down value? In that tax written down value, there will be transferred to the new company. Tax written down value of the asset of A will be transferred to AB Limited. Tax written down value of the asset of B will be transferred to what? AB Limited. But when the new company, which is AB Limited, take over the assets and the tax written down value, they can only claim annual allowance on the tax written down value. They cannot claim initial allowance again or investment allowance. They can only claim annual allowance. They cannot claim initial allowance or investment allowance. Hope you understand. Do you understand?
I have a question, sir.
Okay.
So the annual allowance claimable, is it depending on the remaining useful life of the asset, or are the assets? Okay.
The annual allowance claimable will depend on the remaining useful life of the assets. If the asset has more 4 years to live, the annual allowance they will claim will be based on the 4 year. Hope we understand. Now, number 5 tax implication, unabsorbed losses and capital allowance brought forward. Company A and Company B, they are the one merging together to become AB Limited. Company A may have unrelieved loss at that time of merger. And he has ceased operation. Company B may have capital allowance carry forward because of restriction in the previous year of assessment. Now, such kind of capital allowance or unrelieved loss will not be allowed to be carried forward to the new company, cannot be set off against the profit of the new company, which is AB Limited. Do you understand? That unabsorbed losses or capital allowance of the old company, either A or B, brought forward, cannot be set off against the profit of the new company, which is AB Limited. So that is another tax implication. Another tax implication, stamp duties will arise on the share capital of the new company. You know, AB Limited, A and B, they are combining together to become AB Limited. As a result of combination together, their share capital will change. Their share capital structure will do what? Will change. Since their share capital is changing, their share capital will increase, definitely. When you increase share capital, you must pay what is called what? Stamp duty. Stamp duty is a tax on its own. So anytime you issue new share capital, on that new share capital, you must pay what? Stamp duty. So this number 6 is saying that as a result of conversion, there will be increase in share capital. Such increase in share capital will attract a tax called stamp duties. So that is number 6, tax implication. Number 7, tax implication, merger costs. Merger costs. What is merger cost? Because of the merger between A and B, it will require the service of some professional. It will require the service of some professional. It will require valuation of assets. It will require valuation of stock. So they will spend some costs. Such kind of costs that they spend to ensure that the merger is successful is called merger costs. That merger cost will be treated as disallowable expenses because that merger cost is just regarded, is just like preliminary expenses. And we know preliminary expenses under tax is treated as what? Disallowable expenses. Number 8, tax implication. Number 8, tax implication means value-added tax and withholding tax will be paid on, will be charged on the fee paid to the professional that render service in connection with the merger. When two companies want to merge together, they will require some professional. They will require accountants. Accountant will help them prepare merger accounts. You will merge the asset together. In our SFN, there is something called merger account. By merging asset of two companies together, they will require the service of an accountant. Also, merger, it will involve some legal implication, legal aspects, agreements. So they will require the service of a lawyer. So when they are paying the professional fee for such kind of service that is required, that professional fee will attract what? Withholding tax and what? Value-added tax. Because if I render, I own auditing firm, I'm now rendering auditing service to my client. I'm an auditor, external auditor. Anytime I send my audit fee, before my client pay me my audit fee, it will deduct what? Withholding tax. But when I'm sending my audit fee, assuming my audit fee is 100,000, I will add 7.5% what? I'll add 7.5% of what?
VAT.
Of VAT. So professional fee paid in connection with professional service render during the merger will attract value-added tax, and what? Withholding tax. Ladies and gentlemen, this topic of merger and acquisition is very important. It's very important. A question can come from merger and acquisition this time around. Let's take note of it. You may be asked, they may give you a case study. They will now ask, explain or advise the company on the tax implication of XYZ and BUK merging together. You will now be, all these points I mentioned, I just mentioned, you'll be mentioning them one by one. The share capital of you start mentioning them one by one. You'll be relating them to the company given to you in the exam. For the old company, XYZ is the old company. Company XYZ and company BUK is deemed to cease operation. Cessation rule we apply to them. The new company is now KPMG. KPMG is deemed to commence business, while commencement rule we apply to them. You'll be referring them to the case given to you in the you not just mention these points direct. The capital allowance of the tax written down value of XYZ and BUK will be transferred to KPMG, and only annual allowance should be claimed based on the number of remaining years. You just be, all these points I just mentioned, you just be relating them. Like this point I mentioned, that unabsorbed losses and capital allowance brought forward, it cannot be set off against the profit of a new company. What will now happen to that unabsorbed losses and capital allowance? When company A and company B merge together to become A and B, one of them now have unrelieved loss, while one have capital allowance carry forward. What they will do is, since they want to cease operation, cessation rule has applied to them. In that year of cessation rule, they will do what is called capital allowance carry backward, or loss relief carry backward. They can carry backward capital allowance for maximum of 5 years. They can carry backward loss relief for maximum of 5 years. It backward apply when a company want to cease operation, they are not doing business again, they now have any loss, or they have unrelieved capital allowance. They have a right to carry it backward. It means they will recompute the tax liability of the previous year. So if you look at the tax implication, number 9 tax implication, number 10 tax implication, which is number 9 tax implication, I said unrelieved capital allowance of the cessation can be carried forward and set off against the profit of the old company for 5 years. Assuming company A has capital allowance that they have not relieved in that year of cessation, they can carry it backward against profit of the previous year for maximum of how many years? 5 years. Likewise, too, any unrelieved loss of cessation cannot be carried backward. Loss cannot be carried backward. Only capital allowance can be carried backward. Sorry. You cannot carry loss backward. You can only carry what? Capital allowance backward. So unrelieved losses at the cessation we deem to be what? Lost. Unrelieved losses at cessation we deem to be what? Lost. So look at point I've mentioned, tax implication of merger. They can ask tax implication of merger, or they ask what is tax implication of a new company taking over existing company. They are still referring to merger, because AB Limited is a new company. Existing company is A, existing company is B. So please take note of that. They may not ask, what is tax implication of merger? They may ask, what is tax implication of new company taking over an existing company? Hope we understand that. Now, we have done that. Let's look at tax implication of acquisition. Acquisition simply means, what is acquisition? Company A want to acquire company B. Company A want to take over asset of company B. In acquisition, company A will not lose its brand, while company B will lose its brand. Company A will still be continuing its business. Company B will cease operation because company A want to take over asset of company B. Acquisition is different from merger. Company A want to acquire company B. That is acquisition. When company A acquire company B will lose his brand. He will lose his name. Company A will still maintain his name. He will not lose his name. He will still continue his business. Example of acquisition. Access Bank acquire Diamond Bank. Access Bank acquire what? Diamond Bank. That one is acquisition. Access Bank does not lose his name. Access Bank still remain what? Access Bank. But Diamond Bank, we don't have Diamond Bank again. Hope we understand acquisition. So in an exam, they can ask, another way they can ask acquisition, they can say an existing company absorb another existing company. An existing company. What is the tax implication of an existing company? Absorbing another existing company. That one is acquisition. Hope we understand. Hope is very clear. Now, let's look at the tax implication of it. Number one, under the acquisition, the company absorbed will be deemed to be ceased business and cessation rule we apply to it. Company A is the one who want to acquire another company. Company B is the absorbed company. Company B will cease business. Cessation rule we apply to him. Number two, tax implication. The company that absorbed, which is company A, will not deem to have commenced commence a new business. We will not assume company A is commencing a new business. No. As far as the nature of business, after absorbing company B, his nature of business does not change from his old business. If after he absorbed company B, his nature of business change, we can say, he just commenced business. In that case, commencement rule can apply. But when company A acquire company B, his nature of business does not change after he acquire company B. Commencement rule will not apply. We assume company A is still a going concern company. Commencement rule will not apply. The only situation where commencement rule will apply is in a situation whereby company A acquire company B. After acquiring company B, the nature of business of company A now change. In that case, we assume company A commence a new business and commencement rule will apply. Number three, tax implication. The surviving company, which is company A, is the one that acquired. We not entitled to investment allowance or initial allowance on the asset transfer to it. You know, the asset of company B now has been taken over by who? Company A. Tax written down value of the asset of company B will only be entitled to what? Capital allowance based on the number of remaining years. It will not be entitled to an initial allowance or annual allowance again. Now, another one. The unabsorbed losses and capital allowance of individual merging company may not be carried forward. Sorry, this one is a mistake. the unabsorbed losses and capital allowance of the absorbed company can be set off against the profit of the existing company that acquired that absorbed company. That is what I want to mention here. I will send the correct note. This number 4, the unabsorbed losses and capital allowance of the absorbed company will be taken over and set off against the profit of the company that acquired the absorbed company, which is the surviving company. Another tax implication: fee payable for professional service in connection with that acquisition will attract VAT and withholding tax. When company acquire another company, definitely there will be increase in share capital. That increase in share capital will also attract what? Stamp duties. The assets of company B that is taken over by company A is going to be taken over at market value. At what? Market value. And as a result of that, capital gain tax may arise. Why will capital gain tax arise? When your purchase consideration is greater than the net assets, it means there is a goodwill. That goodwill is going to attract what? Capital gain tax. In acquisition, when the purchase consideration is greater than the net assets of that company that they want to take over, it means there is a goodwill, and the goodwill will attract what? Capital gain tax. Hope we understand. Hope we understand.
I have a question, sir, please.
Okay.
So, regarding the expenses incurred at the process of the acquisition, is that also being considered since this business is treated as being continuous?
The expenses incurred at the process of acquisition, do you understand?
Yes,
Will
sir.
be capitalized as part of the net asset of the acquired company.
Oh,
Hope you understand.
yes, sir.
Okay.
Thank you.
That is another tax. So let's look at another tax implication. Tax implication of a reconstituted company. Tax implication of what? Reconstituted company. 1 minute. Okay. Tax implication of reconstituted company. What is the tax implication of reconstituted company? A reconstituted company is incorporated to carry out a trade or business previously carried on by foreign company. And the asset employed by foreign company in that trade or business invested in the reconstituted company. A foreign company come to Nigeria to come and be doing business. when they come to Nigeria to come and doing business.
We can hear
After they
you.
now want to leave,
So I didn't hear what you said initially. Your voice was kind of low.
okay. I said the next line, the next area that we want to look at is tax implication of what? Reconstituted company. Reconstituted what? Company. What is reconstituted company? Reconstituted company is incorporated to carry out a trade or business previously carried on by a foreign company. The asset employed by that foreign company in that trade or business is vested in the reconstituted company. And I want to explain what is reconstituted company. Let me just explain it in a layman. A foreign company that is not registered in Nigeria, they come to do business in Nigeria. Maybe they have a branches in Nigeria. They come to do business. They now have assets in Nigeria. When they are now going back, some Nigerian indigenous now said, this is your assets. This kind of business you are doing, let us be doing it. Do you understand? They now went to go and register a new company in Nigeria that will be carrying out the same trade of that foreign company. And that new company will now take over the asset of that foreign company. That is reconstituted company. They reconstitute their structure. Now, their board of directors change. Their shareholding structure change. Do you understand? It's still the same company, but the board of director or the shareholding structure change. What is the tax implication of a reconstituted company? Number one, commencement rule or cessation rule shall not apply to a reconstituted company because it's still the same company. They just change the shareholding structure or they change the board of director. Number two, tax implication. The asset vested in the reconstituted company shall be deemed to be sold out on the day of incorporation of that company. Another one under the reconstituted company. The reconstituted company shall not entitle to any initial allowance on those assets and shall be deemed to receive capital allowance granted to the foreign company on those assets. Unrelieved losses of the foreign company on the date of reconstitution shall be deemed to be incurred by that reconstituted company and shall be set off against the profit of the first year of assessment of the reconstituted company. So these are all tax implications of a reconstituted company. Now, let's look at another one that is so important is tax implication of conversion of partnership business to limited liability company. Tax implication of what? Conversion of partnership business to what? To limited liability company. a partnership business, A, B, C, and Co. It has partner A, partner B, partner C. As a result of aging of the partner, the partner now decide
Sorry, sir.
thank you. As a result of aging of the partner now decide that this is our partnership business. Let's convert it to what? A limited liability company. What is the tax implication of conversion of partnership business to limited liability company? Number one, cessation rule we apply to the partnership business. And profit or income arising from the cessation shall be based on what? Shall be computed or based on what? Personal income tax. You know, partnership business is subject to what type of tax? Partners, they are subject to what type of tax? A partners is just like a sole proprietorship. They are subject to what type of tax? Personal what? Income tax. Me and you, we are individual. In our salary every month, they deduct tax. Which type of tax they deduct from our salary? Personal income tax, otherwise called payee. Likewise, partner is subjected to what? Personal income tax. We now say cessation rule we apply to that partnership business. Profit arising from that year of cessation will be subjected to what? Personal income tax. Number two, commencement rule we apply to the new limited company, the company that they converted to, that new company. Commencement rule we apply to that new limited company. Profit arising from that commencement will be subjected to which type of tax? Company income tax and education tax. Company income tax and what? Education tax. Number three, tax implication. That new company that they just converted to, the incorporation expenses incurred for the new limited company shall be treated as preliminary expenses and will be regarded as what? Disallowable expenses. It's not allowed for tax purpose. The incorporation expenses incurred for conversion of that new limited company will be treated as what? Preliminary expenses. And preliminary expenses is regarded as what? Disallowable expenses. Another one, the new limited company will be required to register with who? Federal Inland Revenue. You know, when they are in partner before, when they are partner, they are not required to register with Federal Inland Revenue because they are just like sole proprietorship. They pay personal income tax. The State Board of Internal Revenue that will collect personal income tax. But they are now converted to limited company. That limited company will be required to register with who? Federal Inland Revenue Service. And for within 6 months from the date of commencement of business. Another one, professional fee paid in respect of conversion of partnership business to limited company. We attract withholding tax of 5% and value added tax of what? 7.5%. The capital of the partners, each of the partners, they have capital in that partnership business, will be converted to what? Ordinary share capital under the new limited company. And stamp duties will be paid to the shares. Hope we understand. Hope we understand. So this is conversion of partnership business to.
Sorry, sir. Let me quickly ask, sir.
Okay.
From this conversion of partnership business into limited liability company, is it the same as when you are converting sole trader to a limited liability company?
Yes, it's the same. It's the same. It's the same.
Okay.
Yeah.
All right. That's fine. Thank you.
So please, this is taxation of what? Merger and acquisition. So a question can come. What is the tax implication of an existing company absorbing another existing company? When an existing company absorbs another existing company, what do we call that one?
Acquisition, sir.
Acquisition. So they are asking for tax implication of acquisition. If they now ask, what is the tax implication of a new company taking over an existing companies? That one is what?
Merger.
Merger. So please, let's take note of that. Let's know all these tax implications. They are very important. So this area, I can normally set it like every 4 diet, every 3 diet. I was reviewing the past session. It has been long because I'm trying to look at where may likely come out in these diets. One of the area I'm thinking may come out directly in this diet is one of these. Number one, corporate tax incentive. Number two, this taxation of merger and acquisition. One of that two must come out. Corporate tax incentive that we did last, or merger and acquisition. At least 20 mark question will come out in this diet. So they may divide it. 5 mark. Tax implication of merger, tax implication of acquisition, tax implication of reconstituted company. So please, let's take note of that. So thank you very much. So another area we want to look at today is just a small topic. That one is called tin capitalization. Tin what? Capitalization.
Sir.
Yeah.
Sorry, please, before we go to the new topic, I'm still confused about the reconstituted company. You said something about the assets of the considered company not being allowed initial allowance and investment allowance. And then I was thinking, since when a company, foreign company operates in Nigeria, they're not granted any capital allowance, right? It's only the profits made in Nigeria that is taxable. So how come when they incorporate as a Nigerian company now, they're not allowed to gain initial allowance and investment allowance?
Your question is not clear. You can ask again.
Okay. So from our previous lectures, right, you said something that when a foreign company operates in
Yes.
Nigeria, but are not incorporated in Nigeria, they are not allowed or granted any capital allowance.
Yes.
Okay, now this reconstituted company is incorporating in Nigeria for the first time, right, and has not been granted any capital allowance in Nigeria before. So how come are they not allowed to gain
In my
the
previous
initial
lecture, I
allowance and
said
annual allowance?
when a foreign company that have a fees base in Nigeria, we have assets in Nigeria. In my previous lecture, I mentioned fees based. You understand fees based?
Yes, sir.
Branch, factory. So the foreign company we are referring to in this lecture, we are referring to a foreign company that have an office in Nigeria, that have an asset in Nigeria. We are not referring to a foreign company that don't have a fees base in Nigeria, that just come one off and make profit. No. We are referring to a foreign company that have an asset in Nigeria.
So like a subsidiary in Nigeria
Not a
or a
subsidiary,
branch.
a
Okay.
branch. A branch. Do you understand? So, the branch that they have will be subjected to tax in Nigeria, but it's not registered under Corporate Affairs Commission. They may now decide that, this branch, let's register it under Corporate Affairs Commission. It's now a reconstituted company. Or reconstituted company simply means there may be a law in Nigeria that any company owned by a France citizen, they have to close up the company. Do you understand? And we have a big company that the shareholder, the director, they are from France. What that one means is that new investor will come in to come and take over the company. If you are familiar with football, Chelsea is just like a reconstituted company. Chelsea, because there is change in what? Ownership. At a time, there is a law that said, the former owner of the club, because he's from this area, he may not have opportunity to own assets or own company in UK. As a result of that, he has to be forced to sell the club. Chelsea still remain the same, but there is change in what? Ownership. Hope we understand. That is the constituted company. So, hope my question is clear enough. My answer is clear enough.
Yes, it is. Thank you, sir.
Now, let's go to think capitalization and tax implication. What is think capitalization? Thin capitalization simply means a situation whereby a company is highly geared with debt structure. You know, under your SFM, the capital structure of the company can comprise of debt and equity. Do you understand? In a situation whereby the debt is like 80%, while the equity is like 20% of the capital structure, in that case, there is what? Highly geared company. In that case, that is what is referred as thin capitalization. When we have the highly geared, the debt is like 80%. The effect of that is the interest on the debt that they will be paying will be high. Abi? Interest on loan or interest on debt, is it allowable expenses or disallowable expenses?
It's allowable expenses.
It's allowable expenses. But it's allowable expenses. But some companies now use thin capitalization technique as a means of reducing their profit. How? They will ensure that the capital structure is highly geared by debt. When there is high debt, the capital structure of the company, the loan, the debt that they have is high. I say when the debt is high, the interest on debt that they will pay will be high. In that regard, the tax that they will be paying will be what?
Will be small.
Will be very low. So that is what is called thin capitalization. OECD is just like regulator of regulation of international tax. In our financial reporting, our corporate reporting, we have IASB, International Accounting Standard Board. We have IFAC, International Federation of Accountants. Abi? Am I right? In corporate reporting or financial reporting, they are the ones that regulate standard, IFRS. In tax too, anything that has to do with international tax, the regulator, one of the regulator of international tax is what is called Organization for Economic Cooperation and Development, OECD. Hope we understand. Now, when companies, they are now using thin capitalization to reduce their profits, OECD now come up with a recommendation. They now said, this thin capitalization that people are using to reduce your profits, we need to regulate thin capitalization. We need to regulate it. How do we regulate it? We need to restrict your interest. It means it is not all the interest on loan of a company will be an allowable expenses in that year. If a company has high interest on loan, we will restrict it. How do we restrict it? They are now saying your interest on loan that is allowable expenses that arise as a result of highly geared debt should be restricted to your any before interest, tax, and depreciation. Any before what? Interest, tax, and depreciation. Implication of thin capitalization. What is implication? when a company is highly geared, what is the implication? Number one implication is erosion of tax base. The tax that they will be paying, they will be eroding it from profit. The tax will be so low, they will be moving profit from one country to another. Profit shifting. Clean capitalization will ensure that there is a profit shifting. How? You know what multinational companies do using T capitalization? They will set a multinational company in Nigeria. They don't want to pay tax in Nigeria. They will now set their parent company borrow them money, borrow them a loan. Do you understand? Their parent company borrow them a loan. In their expenses here in Nigeria, they will now write interest on loan that their parent company borrow them. And the loan is so huge. And they are not making use of the loan. No. They just put it in their financial report statement because they want to reduce their tax. They will now set the interest on loan that their parent company borrowed them is an expensive. They will now use it to reduce their tax. That one is called profit shifting. It means they are shifting their profits from Nigeria to a low tax. So they are shifting their profit from Nigeria to a tax haven. Tax haven means a country that don't charge tax because of religion, or they are paying low tax. So one of the implications of thin capitalization is erosion of tax base, profit shifting. Number two, profit shifting. Number three, tax avoidance. They want to avoid tax. They are now introducing interest on loan to reduce their tax. Another implication, encourage fiscal evasion. People look at thin capitalization as a means of evading tax because you went to go and borrow money that you don't make use of. You are not paying interest on that money. You now say they are charging you interest on that money. You borrow it from one of your related companies. You are now paying interest to that your related company in order to reduce your tax in Nigeria. It's an evasion. You don't want to pay tax. So those are the four implications of thin capitalization. Now, for the sake of time, thin capitalization rule in Nigeria. Thin capitalization has been existent for over like 10 years ago. OECD have recommended thin capitalization like 10 years or 15 years ago. Some country they are practicing thin capitalization rule for over 10 years ago. But in Nigeria, thin capitalization rule means how do we restrict the interest? How do we restrict the interest? How do we ensure that all the interest on loan will not be subjected to tax, will not be a liable expense, will not be used as an liable expenses, so that they will reduce their profits? How do we ensure that all your interest on loan is not what you use as an liable expense because you want to reduce your profits? So we need to regulate thin capitalization. Thin capitalization regulation is called thin capitalization rule. Thin capitalization rule in Nigeria started in 2020. Finance Act 2019 introduced it. Finance Act 2019 was the one that introduced think capitalization in Nigeria. So think capitalization in Nigeria, the effective date is January 2020. What does that now mean? Under the Finance Act. Finance Act 2019 mentioned the issue of think capitalization. It's now saying that when company has much of interest on loan, we should restrict the company interest on loan to 30% of any before interest, tax, depreciation, and amortization. What that one means is that assuming in the company profit and loss, they say their interest on loan is 2 million naira. They are claiming that the interest on loan is 2 million naira. Think capitalization rule is now saying they cannot use that 2 million naira or the 2 million naira as an allowable expenses. What they will use as an allowable expenses will be 30% of earnings, profit. Earnings means profit. Before interest, tax, and depreciation. If 30% of profit before interest and tax and depreciation is giving you 1.5 million naira, it means the interest on loan that will be recognized as an allowable expenses will be 1.5 million naira, not the actual 2 million naira that they recorded. The balance, the difference between that 2 million naira and 1.5 million naira is called excess interest. Excess interest can be carried forward for maximum of 5 years. Excess interest can be carried forward for maximum of what? 5 years. You can be asked, okay.
The carry forward means it will be allowed for the minimum of 5
Yes,
years.
it will be allowed in the next year. Do you understand? It will be allowed in the next year, but you can't allow it this year. You must pay tax this year. You want to reduce your tax this year. That is the reason why we are restricting it for you. You can carry it forward. If next year too, we don't have enough profit, we still carry it forward. We can carry it forward for maximum of 5 years. For the next 5 years, assuming we don't have enough profit that we can remove that excess interest, it means that excess interest after 5 years is lost. You can't use it again. Hope we understand.
So I have a question.
Okay.
I don't know. I think the other lecturer, right, said something about this excess interest being deductible on first in, first out basis, but I don't really understand it.
First in, first out basis. In 2020, you have excess interest. 2021, you have another excess interest. In 2022, you now have enough profits. Which one are you going to deduct first? Excess interest of 2020 first. You deduct that one first from the profit of 2022 before you consider excess interest of 2021. That is first in, first out. Hope you understand.
Yes, sir. Thank you, sir.
So you may be asked, discuss think capitalization rule in Nigeria. Discuss think capitalization rule in Nigeria. You need to let them know that think capitalization in Nigeria was ruled in Nigeria was introduced by what? Finance Act 2019. And you now stated that the act states that anytime there is an interest that is much, the interest should be restricted to 30% of any before interest, tax, depreciation, and what? Amortization. And you also let them know that excess interest arising from the restriction can be carried forward for maximum of how many years? 5 years. Hope we understand. Maximum of 5 years. Now, let's look at this question. Can we look at this question today, or we should put it next week?
We can, sir.
Okay. Yeah, somebody should read.
XYZ Limited was incorporated on August 31st, 2012, and it commenced business on May 31st, 2013. Dickey Malaysia Limited is its subsidiary in Malaysia. An extract of the financial statement of XYZ Limited for the year ended 31st December 2020 revealed the following. Accessible profit, 2 million. Interest and depreciation deductible before arriving at the accessible profit, 2 million, are as follows. Interest or loan paid to Dickey, that's the subsidiary, right? 1,050,000. Other creditors, 1 million. Depreciation, 400,000. Based on the information provided by the company, it was discovered that out of the interest on loan paid to other creditors, 450,000 naira was in respect of a loan obtained to generate tax-exempt profit.
Okay.
Can you go up, please? Okay. The managing director of XYZ Limited approached you as a tax consultant to explain the provision of Section 24 of CETA 2004 as amended and the 7th schedule in respect of the interest deductible by a Nigerian company required. A. Compute the interest deductible in the relevant assessment year.
B.
B. Compute the tax liability of XYZ. C. Explain how the excess interest not deducted in the relevant assessment year would be treated.
Mm-hmm. We are given what? Let's go back to the question. Accessible profit. Abi? They now said interest and depreciation deducted before arriving at the accessible profit of 2 million are as what follow. The interest, one is from their related party, their subsidiary, while the other one is from their creditor. There is depreciation. Now, if you want to get any before interest, tax, and depreciation, what do? We know that we add back the interest and what?
And the depreciation.
Depreciation. We add them back. So look at how I do it. Accessible profit of 2 million. Depreciation, 400,000. The interest, the two interests are added by belt. I get any before depreciation and interest. My second question now is, this interest that was given to us, 2,050,000, The question now convinces us. And I said, based on the information provided, it was discovered that out of the interest on loan paid to other creditor, 450 of it was in respect of a loan obtained to generate a tax-exempt profit. You collect a loan to generate a tax-exempt profit. It means that loan, the business you use it for, is not what? Taxable. Will the interest be allowable as an expenses?
No, sir.
No, sir. So your first adjustment out of this 1 million interest, you need to first of all say which one is allowable as an expenses out of this 1 million interest. Is for you to remove the 450 from the 1 million to know the one that will be allowable as an expenses. Because when an interest is used to generate a tax-exempt profit, the interest cannot be used as an allowable expenses again, because the activity that is used to generate, you cannot pay tax on it. Why are you now deducting it as an expenses from other activities? So our first adjustment is for us to adjust the interest. After we get any before depreciation and I added all the interest, I now said less the interest that generate tax-exempt profit. It means the interest available as an expenses, that is available as an expenses, is now what? 1,600,000. Now, let's go back to our question. The question said we should compute interest deductible in the relevant year. The question is asking us that which interest are we going to deduct from profit before we compute our tax? How do we know the interest deductible? We are going to look at the interest we have that is available. We compare it with restricted interest. The lower between the two will be the one that will be deductible. So if you look at my A part, computation of interest deductible, I say lower of interest available for deduction, 1.6. This 1.6 is the one that is available as an allowable expenses that is available. You now want to follow the thin capitalization rule. Thin capitalization rule is saying that anytime that we have interest on loan, we should be checking for restriction. Let me check for restriction of this question. 30% of any before depreciation and interest, 30% of it is giving me 1,335,000. Since 1,335,000 is lower than the actual interest available, it means I'm not going to use the actual interest as an allowable expenses. I'm going to use the restricted interest. Hope you understand. Hope you understand. You can ask a question. You can ask a question. This is the interest available for deduction as an allowable expenses, even without thin capitalization rule. This is the interest we are going to deduct as an allowable expense. Let's follow thin capitalization rule. 30% of our earning before interest and depreciation is giving us 1.3350. It means this 1.6, I'm not going to use it as an allowable expense. The one I'm going to use as an allowable expense, the interest deductible, will be 1.3350 because it's the smaller. If I go and use 1.6, our profit will reduce, tax will reduce. So it's the smaller one I'm going to use B part of the question now. B part of the question said we should compute the tax liability of XYZ Limited. We know any before depreciation and interest, any profit before depreciation. We know that depreciation is a disallowable expenses. We cannot minus depreciation again because depreciation is a disallowable expenses. So any before depreciation and interest that we get at the up, we now less the interest deductible, the interest that we restricted, we less it, is the one that is allowable expenses. We cannot less 1.6 because 1.6 is much. It will reduce our profit. We have to follow thin capitalization rule. We less interest on loan deductible, which is the restricted interest. We get adjusted profit. After getting our adjusted profit, we less our capital allowance if we have. We get our taxable profit. We now compute our tax. How do we compute our tax? CIT at 30% of adjusted profit, of taxable profit. TET, education tax, at 2% of adjusted profit. It will give you this. So this is the second requirement of the question. Said you should compute the tax liability. The third requirement of the question said,
So I have a question.
okay,
In the requirement 2, right? During the computation of adjusted profit, why are we not deducting the 450 non-taxable profit from the amount?
doing the computation of what?
The adjusted profit.
Where is adjusted profit? Why are we not deducting? Okay, doing the computation of adjusted profits. Are we?
Yes, sir. The
Why
earning
are we
before
not
the
deducting?
depreciation and the interest.
Why are we not
It has,
deducting what?
so the earning before the depreciation and the interest that we use here
Yes,
has the element of the non-taxable profits in it.
it has the element of.
The tax exempted profits in it.
It doesn't have it before before depreciation and interest. Before we deduct depreciation, before we deduct interest. Do you understand? That is the reason why we now later come and deduct this interest. Any before, at the beginning of the question, they have already deducted it. We had it back at this beginning. Before they gave us 2 million accessible profit. We had everything that they have deducted before they arrive at the 2 million. We had it back to get any before depreciation and interest. We had it back. Any, it means profit before depreciation, profit before interest. And we know that for us to get our adjusted profits, we know that we are giving profit before depreciation and interest. We know that depreciation is a disallowable expenses. We cannot minus depreciation again. But interest is an allowable expenses. We have to minus interest. We have to minus interest. That is the reason why I minus less interest on loan deductible. Hope you understand. You get your adjusted profit. If there is capital allowance, with less capital allowance, we get taxable profit and we compute tax liability. C part of the question said, explain how excess interest not deductible will be treated. How do we get our excess interest? Look at it. This is the interest available as an expenses. But this is the restricted interest that this 1.3350 is now the interest that we actually use as an expenses. But this is the interest that is available as an expenses. The difference between the two will be the excess interest. So
I think
now,
that's where exactly I'm confused. The fact that we did not deduct the 450 interest payable on tax exempted profit.
we deduct it, madam. See,
Is it doctor?
see,
It's different.
can you see? The total interest before is 2,050,000. We deduct it here to get 1,600,000. Hope you understand. We deduct it.
So maybe I can private chat you on
Okay,
that.
no problem. No problem. So the interest available as an expenses is 1.6. The interest we now use when we are doing our tax computation that we restrict based on the things capitalization rule is 1.3350. The excess interest that will be carried forward is what? 265. And we let them know that the excess interest will be carried forward for a maximum of how many years? 5 years. So that is that on thing capitalization. So, ladies and gentlemen, that is what we have for today. In case you have any question, you can private chat me. Any question now? Any observation? Let me know before we close. So
Are you trying to say that for every account given and maybe interest, they give us interest, right? We must find 30%. We must restrict it to 30% of any before interest and
yes, sir. When we are computing like the tax liability, when we are computing against the we must restrict it. We must follow. Think capitalization is a must now.
because normally what we do before is that we allow the interest.
We allow it. We must check for restriction.
We must check that 30%.
Yes. Assuming the 30% is now greater than the actual interest, we use the actual interest. We hope you know that.
Yes.
So any other question? So in the absence of no question, you can call it a day. Thank you very much. Thank you for having me.
Thank you, sir.
Yeah.